What's up guys, welcome back to Money Crow, the channel all about making your money grow. In this video, I'll be going over the top 5 investing mistakes that I have personally made on my investing journey. These mistakes have hindered my progress and I want to share them with you so you learn from me and don't copy what I did. Number 1 is analysis paralysis. Pretty much what this meant for me was that I wanted every single investing decision to be perfect and optimized to the fullest. But obviously that's almost impossible to achieve. So while all the research I was doing said to invest as soon as possible and as much as you could afford to, and the data from the past century backed up that logic, I was playing it way too safe and procrastinating actually investing because when I first started, my risk tolerance was extremely low. I didn't want to lose any of the money that I was investing, so this in turn prevented me from participating in some of the stock market's massive gains. In addition, I wanted my asset allocation to be absolutely rock solid, so rather than starting somewhere, I spent a lot of time just working on an asset allocation that I thought correlated well with my risk tolerance. But again, this was the wrong way to go about it. It would have been far better for my portfolio and my growth as an investor to just start somewhere, anywhere, and learn as I went. So my advice to you guys is don't spend months and months or years like I did trying to find the best thing to invest in and the best way to do it. And don't be scared of being wrong, especially when you're barely starting out. Remember to start small, then when you get the hang of it, increase those numbers. Start your investing related growth and education sooner than I did, and don't get paralyzed by overthinking things. Number 2 is timing the market. I made an entire video recently about why timing the market is a fool's errand. It just won't work consistently over the long term. And failing to time the market correctly, which is arguably all due to luck rather than skill, is absolutely detrimental to your success. Watch my video about this topic to have your mind blown on the difference in your portfolio's performance with and without market timing. A fantastic quote about this is the famous investor Peter Lynch saying, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves." When I first started investing, as I mentioned earlier, my risk tolerance was so low that I didn't want to invest any money because I just knew that a crash was about to happen. I said to myself, there's just no way the market can keep going up and up and up. There were so many data points all agreeing that the market was overvalued and we were due for a massive correction at any moment. The thing is, there were some corrections. That's normal and healthy in the stock market. But like Peter Lynch said, I lost more money waiting for those corrections because I would have made so much more just being invested and being a part of those insane upward movements that the stock market regularly makes, even accounting for the corrections that happen in between or after that type of growth. And if you're currently the type of person to have no risk tolerance like I once did, even if there is a correction, your mind will tell you, nope, it's not done dropping. This is barely the beginning of the massive crash. Don't buy yet, wait a little longer. And that mindset is what destroys any benefit you could have had by waiting for a market downturn. So what did I do to fix this, and what should you do? I simply invest every single month without paying any attention to where current prices are. Just think about it this way. If we expect the market to continue its trajectory that it's had for the past century, going up 10% per year, then it's only logical that the market will gradually become more and more expensive over time. So it's kind of silly to expect no growth, and it's counterintuitive to not buy stocks just because they're going up in value. Number 3 is trading too much and too often. This sometimes coincides with buying high and selling low, which is the opposite of why one invests. A personal example with this was a trade I made in 2018. I was positive Facebook stock was so undervalued when it was trading at around $180 per share. I remember that year I maxed out my Roth IRA and went all in on Facebook at around that $180 share price. This was around January of 2018. In the coming months though, Facebook dropped all the way down to the 150s, which was pretty devastating for me going all in on that stock. Soon after, it recovered to its 180 share price and I was just happy to get out of that stock at my initial cost basis, so I sold right away. A little later though, Facebook went up above $200 per share and I was kicking myself saying, see, I knew I was right, why did I sell? I gotta get back in the stock. So I bought back at that much higher price, and as you can already tell from the graph, Facebook would then proceed to drop all the way down to the 120s. However, just like last time, I held on this time again until it had recovered above $200 per share, and when it did, I sold again. Unfortunately for me, today Facebook trades at $274 per share, and I would have been much better off simply holding the stock. I would have been even better off than that had I consistently been putting more and more money into Facebook stock all throughout its journey of rising and falling in price. My cost basis would be much lower because I would have bought consistently all the way down to their $150 per share price, all the way down to their $120 per share price, and had a greater profit when it recovered. However, focusing all your cash to investing in just one individual stock is a terribly risky idea, and it actually brings us to the fourth investing mistake that you need to avoid. Number 4 is not being diversified. A lot of new investors, and I had this problem too when I first started, is they find a stock that they consider an amazing investing opportunity and they become emotionally attached to that stock and think it can do no wrong. For many people today, that stock could be something like Tesla, which has gone up 778% just in the past year and 1,363% over the past 5 years. According to Robinhood, it has a PE ratio of 1,219, which I understand is a bit of a simplistic way of looking at the value of a company, but PE ratio is basically the share price divided by the earnings per share, so it gives you a good idea of how many years it would take to recoup your initial investment. With Tesla's current PE over 1,200, that means it would take you a millennium plus 2 centuries just to get your money back. Clearly, Tesla could outperform even our wildest expectations, and it very well might. But what I'm trying to get at is don't invest all your money into just one stock, because that incorporates incredible amounts of risk to your portfolio. Say Tesla does get to a $1 trillion or $2 or $3 trillion market cap. That's great, you multiplied your money. But say Tesla starts a downward trend and worst case scenario goes bankrupt, your entire portfolio would get demolished. You'd be left with nothing or close to nothing. This is why diversification is so important, because you can avoid unnecessary risk and still get very decent returns. I'm sure a lot of you guys are familiar with the S&P 500, which consists of the 500 largest companies in the United States. Being invested in the S&P 500 would have returned around 10% per year over the past century. When your entire investment portfolio consists of 500 companies, even if a handful of them go bankrupt, you have the grand majority of companies thriving and increasing sales and innovation, so the few that go bankrupt don't significantly affect your portfolio. And also, if a company stops being a top 500 company, the S&P 500 simply adds the next company in line and boots that one off, so you're always invested in the largest 500 companies that are constantly growing and being replaced by the next big thing. I made a video about how to build the perfect stock market portfolio, and obviously that's a bit of a reach, but it's perfect for me, and I truly believe it could be perfect for the average person. I explain my reasonings in that video in more detail, but basically I'm a big fan of these following allocations. 70% to VTI, which is the entire United States stock market, so you're extremely diversified and getting your fair share of the entire market's movements. 10% in individual stocks, so you can scratch your itch of wanting to pick the next big stock and maybe hitting it big without risking more than you can afford to lose. 5% in real estate, which can consist of real estate equity in your primary residence, or a real estate investment trust such as VNQ or O. 3% VXUS, which consists of the entire international stock market. The reason I like owning just 3% of this is because by owning VTI, you already own some of the largest companies that have a global presence. And based on the data, the top 500 companies in the US get about 40% of their sales from international sources. So you're already heavily exposed to the entire world just by investing in the US. But to me, it is still valuable to have just a tiny chunk more directly invested in foreign holdings, because you get direct exposure to huge companies like Alibaba, Tencent, Nestle, Samsung, Toyota, etc. I'm also a huge supporter of what Berkshire Hathaway has done, and I'm confident they will continue to be a powerhouse for decades to come. So I recommend a 2% allocation to BRK.B. That way your money gets access to their exclusive deals, their insane career-long track record of investing in great companies, which has resulted in a 19.1% cost-adjusted growth rate over the past 50 years. And you also get exposure to all their wholly owned private companies. Last but not least, I recommend 10% in cash just to have as an emergency fund in case anything comes up in your life. And if no emergencies come up and the pile starts getting too large, it simply becomes a backup pile of cash that you can throw into the market if we experience a large decline, like what happened this past March where the market dropped over 30%. However, if you have access to something like a cheap line of credit or you have an emergency fund elsewhere, I would simply allocate this excess 10% straight into just buying more VTI. So 80% VTI instead of the 70% that I initially recommended. You may be asking yourself, where are the bonds? But since bonds are currently paying very low interest rates and they also suffer from interest rate risk, that basically means when interest rates start rising again, bond markets will fall. So in my opinion, if your goal is to buy and hold for the long term and you're not near retirement yet, I wouldn't even bother with bonds in this current environment. But please remember, there are so many strategies and asset allocations available. Don't just copy my investments blindly. Please do more research and find out what your personal investing personality and goals look like, and just use my recommendations as a reference point. Before we get to the fifth and final mistake that you need to avoid, I just want to give a quick shout out to my amazing Patreon supporters. We have our Crow CEO Jorge Ledesma and our 4 Crow investors Prismatic, Erica, Andrew Paz, and John Harden. Thank you all so much for your continued support. If you guys want to be notified after I make a trade in my $100,000 stock market portfolio, consider supporting the channel on Patreon. I post all my trades on there so you'll be the first to see them. Link is down below in the description. Another easy way to help out the channel is by clicking my 3 different referral links so we can both get free stocks and free cash. For a limited time, Webull is giving away 4 free stocks, and One Finance is giving away $10 in cash, and Robinhood is giving away a free stock like Apple or Facebook or many others when you sign up. Links are all in the description. Thank you guys. So number 5, the fifth and final investing mistake that you need to avoid, at least for this video, is not having clear investment goals. When I first started investing, I had no idea how much I needed to save or why I was even saving in the first place. I kind of knew that the more money I had stashed away, the bigger safety net I had for whatever life may throw at me, but I had no idea my investments could provide lifelong income if grown and withdrawn correctly. This led me to discovering the wonderful world of FIRE, which stands for Financial Independence Retire Early. I've made a couple of videos about it, but basically this community focuses on building a portfolio with the goal of achieving a portfolio large enough to cover 25 times their annual expenses. So say your annual expenses are $20,000 per year, that means a portfolio 25 times larger than that would be $500,000. The idea is, and it's backed up by the 4% rule, which was first articulated by William Bengen and then confirmed by the Trinity study, is that you can safely withdraw 4% of your investment portfolio each and every year while adjusting for inflation. And over the long term, you will only have a very small probability that you run out of money. Specifically, a 5% chance of running out of money after 30 years if your portfolio allocation was comprised of 50% stocks and 50% bonds. So with a $500,000 portfolio, 4% of that is $20,000. That covers all your living expenses. However, that's taking into account a static amount of money that you never contribute any more to. You never earn another penny in your life, and it's also considering the fact that even if we suffer a huge market decline, and let's say your $500,000 drops by, let's say, half, all the way down to $250,000, that you will continue living life as always and wouldn't cut back on spending at all. I'm of the mindset that never earning another dollar in your entire life and also not being willing to cut back on spending during a recession are 2 huge points that make no sense to me. And just adjusting these numbers slightly would lead to a 100% success rate. And based on the research that I found from researching safe withdrawal rates and playing around with many different scenarios on FireCalc, a portfolio comprised of 80% broad market United States stocks, like VTI, and 20% bonds, like BND, with a safe withdrawal rate of 3%, can last indefinitely, pretty much forever, even after you die, which is actually what I plan to shoot for, so I can eventually pass my money on to my family, and also some charitable ventures that I want to be able to fund. So basically, I started out not knowing what the point of saving or investing really was, and now I view saving as future income. Every $1,000 that you save equals $40 in income every single year for the rest of your life. It's changed the way I think about money and investing for the better. I hope you've learned something from my mistakes, and I hope I've saved you years of trial and error by being able to see what I initially did wrong and how I could have done things so much better. Thank you guys so much for watching until the very end. I hope you'll be back for future videos, and as always, please subscribe, hit the notification bell, like, and comment. Have a great day, and I'll see you next time.